G'day there. Welcome to the closing bell on the 13th of September for me, Black Friday. And it's not so scary out there, though, is it? Aussie stocks flying to new all-time highs. We're on the cusp of the first interest rate cut. So let's have a think about that. US two-year bonds trending down on the long term. Have you got enough high yield stuff in your portfolio? Have you got some solid yield in there in case rates drop quite rapidly? We've gone into something like Telstra, good yield, earnings were pretty good. That sort of thing might continue rallying. Some of the property stocks, you saw Charter Hall flying higher. There's a few things out there yielding 6-7%, trading at book value, 0.7 of their book value, those property stocks. Is it recovery phase time? They've got lots of debt, rates coming off the boil, recovery in office property prices, etc., etc. Are they going to go for a bit of a run? So there's things to be thinking about at the moment. The US dollar on the edge of falling through 100, the US dollar index. Is the Aussie dollar about to take off? So that's what I want to focus on today. How's that going to affect your portfolio? How much BHP shares have you got? If iron ore's getting hammered, if the Aussie dollar then takes off to the upside, that's really going to give them a double whammy, isn't it? So we've got to think through what the rate cutting cycle is going to do, how it's going to affect the US dollar, what then happens to commodities. We're seeing gold flying through the roof, aren't we? Hopefully you've gotten onto a few of the gold stocks. We've been telling you about those. Gave you a hint on one a couple of weeks ago. Gave you Resolute Mining just a few months ago, up about 60-70% in a few months. So if you want to learn about what I'm doing, of course, please find my lessons. That's just, things I've learned over the last 20, 30 years trading, just to teach you about how I go about things, how I manage risk, how we use mean reversion to basically get ourselves into a sort of a no-lose situation in trades. And so we can see what happens next. It all sounds very confusing, but it's not when you sort of get taken through how it works, how traders get stopped out of positions, that sort of thing, and you take advantage of that. So please check that out if you can. There's a little eye probably in the top right corner of the screen you're looking at now. If you click on that, you'll be able to click through to the lessons. It's a document that I've just put together for you so you can learn about a few of the things that I use as I trade. So it should be really helpful for you if you follow these videos and maybe don't understand what I'm talking about. So let's just jump to the charts really quickly. I want to race through something for you to make you feel that, yes, the Aussie dollar may be on the cusp of a bit of a run. So just starting on that US dollar, give you a sense of what's going on here. Here's 100 in that US dollar index. Look at this going back to 2015. Can you see how important that level has been? A few attempted moves through it that failed over the years. But it's been great resistance. And then on the upside, we broke through a few years ago, big strong move in the US dollar. The heat came out of that. And we've seen the last few years really has just been treading water as rates were high. And now we're on the cusp of a rate cutting cycle. Do we see that US dollar continue to trend? So the long-term trend, this is a weekly, but long-term trend down on that. When is it going to bust through that 100 level and potentially have a bit of a drop? What happens then? Gold, obviously a beneficiary. It's already flying higher. But other commodities, they've been under a lot of pressure, haven't they? Does this stop the rot? If US dollar really gets hammered, does that help oil prices? And et cetera, et cetera. A lot of stuff getting hammered because of China, the property market over there, iron ore on its knees. Also copper struggling, but still pretty positive in the big picture. This may be a big factor to be considering as rates start to drop. And, really, you've seen that US two-year yield chart. It's now trending down, thinking about how you're positioned there and what sort of exposure you've got to a bit of yield if rates do really start dropping rapidly, if growth really comes off the boil faster than people expect. This sort of thing, that the iShares 20-year Treasury bond ETF, it's something you'd have to buy offshore, maybe through CFD providers, that sort of thing. But this sort of thing, look at that, from 180 down to 84, really hammered. That's how terrible this sell-off has been in bonds. Are we on the cusp of a bit of a recovery? And is that something that is worth getting some exposure to, something like that? So that's the sort of idea on the yield front. But let's jump to a chart which will look confusing, but I'm going to explain it all to you. Now, looks confusing, doesn't it? But I'll explain it all to you, just so you get a sense of the underpinnings of what moves the Aussie dollar. The first thing I need to say is I got this wrong. This is actually the Australian 3-year. So it's actually the Australian 3-year yield minus the US 2-year yield. So that's, if that I'm sure makes sense to you. We're looking at the differential between Australian and US rates. And so when the Aussie rates are, say, going up or above US, that's that green line there is going higher. And then the other way, of course, is our rates getting closer to the US or going underneath the US. So you can see there on that chart, looking at that green line, which is looking at the differential between Australian and US rates. And if we look at what the Australian dollar actually has done over that time, so this is the actual candlestick chart you can see underneath there. That's the Aussie dollar. So that's that chart there. That's the Aussie dollar since 1995. Just notice the correlation between that, the difference between Australian and US rates and where the Aussie dollar went. So we saw that differential rising there. The Aussie dollar did nothing for a while, but then boom, off it went, tracking that higher. Then we've got it going down there. You can see Aussie dollar went nowhere for years. Again, takes off to the upside. Aussie dollar takes off to the upside. So there's a very high correlation there you can see between the differential and what the Aussie dollar is doing underneath. So there's that green line going up. There's the Aussie dollar underneath going up. So you can see what's been going on recently. This whole move from, from above $1.10, that differential really affecting that Aussie dollar. But also we're looking at the Aussie terms of trade. So this is where it gets sort of interesting, looking at the terms of trade, which is that black line. And that is showing you sort of the ratio between export prices that we sell to the world, what we're selling, like iron ore, coal, gas, etc., as a ratio to our import prices. So when you've got the terms of trade going up, often the Aussie dollar is strong when the terms of trade are going up. And you'll see in the past, and that's when our growth is going up and everything's looking great. You'll see here there's quite a strong correlation between the Aussie dollar and the terms of trade. So there's that black line, the terms of trade for Australia. And that was also tracking. The Aussie dollar was tracking that terms of trade quite closely, wasn't it? But there's a big divergence opened up around 2017, wasn't there? You can see here that our terms of trade got better. So we had iron ore prices going through the roof, etc., etc. So terms of trade going better, but the Aussie dollar sold off. And that's because of this interest rate differential. You can see that the green line there continuing to head down, and the Aussie dollar continued to head down. So what that opens up is, we had our terms of trade going up and the Aussie dollar going down. So imagine what that did to the profits of the likes of BHP, which I've got down here. So you can imagine the price of iron ore is going up and the Aussie dollar is going down. So they're selling their iron ore in US dollars and the Aussie dollar is weak. So they get even more in Aussie dollars, don't they? So their profits go through the roof. So we had the BHP there rallying from sub $20 up to $50 over a few years. Really strong rally. And you saw what happened in Fortescue as well. Massive run. And that's this relationship between, uh, you can see there, that's iron ore, that green line there. You can see iron ore prices really strong. But the Aussie dollar was actually selling off due to the changes in that interest rate differential between the US. So that was basically really feeding into massive margins for them. It was like a double whammy. You're selling your goods at a great price and the Aussie dollar's weak to convert it back to Aussie dollars. So that's why you've got that big, strong rally that we've seen in resources for years. Now, we then got the weakness. So you can see there that iron ore prices got hammered a few years ago, but BHP didn't really suffer too much. Now, why is that? Well, again, because the interest rate differential, you can see there going down, which hit the Aussie dollar. So the Aussie dollar got absolutely hammered as well. So even though iron ore prices were going down, the Aussie dollar was going down, kept their margins looking okay. BHP went sideways, looking good for a few years. Now, recently, things are changing. So now we've got, you can see the terms of trade have topped out and are heading down. Usually not good for the Aussie dollar, but we've learned from looking at this that it's more the interest rate differential has a much higher correlation to what the Aussie dollar does. And what we're seeing is this, it's kicked higher, right? So US about to cut rates. We've got the argy-bargy with the RBA saying they're going to hold rates steady because they know, our wage growth still very high, strong. And even our, if you've got the real yield on our 90-year bonds, 90-year notes, you've got a pretty much zero real interest rate. So we're still pretty stimulatory, really. So our rates may stay still and the US rates will be dropping, which means this could actually kick higher, which would, as we've seen before, we had the interest rate differential kicking higher first, and then it was a bit later, a few months later, that the Aussie dollar actually really took off to the upside, helped by the strong terms of trade. So, and also I just want to note, back in 2000, that differential took off. Aussie dollar stuffed around for a while, but then took off like a rocket. So it can be a delayed function. So our Aussie dollar treading water, but even if it's not this month, next month, but it's at risk if this continues with that interest rate differential continuing to head higher as US cut rates and we don't. You're going to see that US dollar kick higher. So we could have terms of trade now coming off the boil and Aussie dollar strengthening. That is a double whammy on the negative side for something like BHP. So all of a sudden, BHP may actually just be in the early stages of selling off. So if you want to buy BHP, I'd be holding off for now based on what's going on. There could be more downside. And that you've seen, everyone's selling out of the resources, aren't they? Rio, Fortescue, etc., for the moment. But if that US dollar really does get hammered, that can feed into holding things in there for those commodities, can't it? So let's have a look at gold. So you can see here with gold, I mean, it is seriously trending, isn't it? It has broken out. We're looking at that 2011 high, and then the high that was in place for about 3 years, really stuffed around there for a long time, gold. And then it's gone into a long-term uptrend. This is when I was telling you to get on, buy. And it's really broken out. And this is where we're really getting convinced that it's trending. And who knows what this trend is going to look like and how far it's going to go. So it's an interesting development recently with gold doing what it's doing, because it's sort of been holding in there and you'll know that I look at these structures. If we're looking at this correction, which occurred over the last few years, this was the range, and I was analyzing everything based on that range. There's your midpoint there. Now, when it breaks out, it really has to go double the range to completely convince me that it is away. And it's done that. It's now broken up. It's saying that the gravitational pull of that point of control, which has been there for years, that's done. And it is now trending. So, US dollar going to sell off further. Um, who knows? Rates could fall and stocks could fall. Like we could be in for that sort of a situation. I'm not going to say stocks are going to just keep going up right now, no matter what. Although they look pretty good, don't they? But from the point of view of rates dropping, getting some dividend yield on board, and this gold price, I don't know where it's going to stop. You want to be on and continuing to ride things to the upside. So to finish off, a little gold stock that's been um, struggling just of late, but has had a really strong run is Red 5. It's still in long-term uptrend. It's sold off from about 50 cents. It's had that merger with Silver Lake recently, and it's sold off from 50 cents down to 27 cents. And you can see that is the long-term moving average, the 20-month moving average. So a nice little bounce off there. If I'm looking at the long-term structure of this, so I'd be looking at this big wave to the upside and then the correction that's occurred and sort of analyzing price action based on that. So if I'm looking at that quickly, just to give you a sense of how these things move, and I've said to you in the past, when you've got a correction set up, you've got the midpoint, that point of control around which prices oscillate, and you've got areas inside the range and outside the range where you expect reversals to occur. So that 25% above, 618 above, and 25% below, and 618 below. They're sort of the areas where I expect to see false breaks, support, and moves back to the point of control. As you can see, over and over, rally nearly to the 618, back to the point of control, sell off where to the 618 below, back to the point of control. We've had another wave to the upside. So a big rally, hitting that level again and moving back to the point of control. So if this stock is strong, that point of control really should hold it. And from here, you're saying it's in long-term uptrend, a nice bounce off there. Well, we're ultimately wanting it to break out above that 50-cent level and continue trending because it's been quite a few years, hasn't it, of being stuck in this range, and it's getting closer to, I think, just trending for a bit, especially if gold can continue. So it's been a nice pullback. It's one of the ones that I think, with gold breaking out like it is, it may be a bit overdone, a bit oversold, and should be a lot of support around for that. So anyway, that's enough, I think, for this week. I'm thinking the Aussie dollar actually is at risk of running, even though commodities have been weak, but due to that interest rate differential, and thinking about that, does it affect some of those big stocks with a lot of offshore earnings? And it's just positioning a portfolio for this new world we're entering. All right, well, I'll come back with more next week. Cheers.